Welcome back to Investing Talk podcast. Today, we're zeroing in on a semiconductor company that's really central to this whole AI explosion, Marvell technology. And the big question, the one we're tackling today, is pretty straightforward. Is Marvell technology a good buy right now?
Yeah, and we've gathered, the financial reports, the charts, analyst views,
Yeah,
trying to give you the full picture, cut through some of the hype maybe.
definitely need to cut through the hype. Before we dive in, though, just a quick reminder, if you find this analysis useful, please hit subscribe, like the video, maybe leave a comment below. Oh, and if there's a specific company you want us to analyze next time, let us know in the comments. We really do look at those suggestions.
We do.
Okay, so let's get into Marvell. Known for, well, high-speed data center stuff, custom chips, ASICs, specialized silicon. We're going to break down the fundamentals, look at market sentiment, see if all this excitement holds up.
Let's start with the top line, the revenue picture. For their fiscal year 2025, Marvell reported $5.756 billion. Now that's up slightly, about 3.4% from the year before.
Okay, 3.4%. Not exactly setting the world on fire, is it? Especially with all the AI talk.
Well, exactly. The sources suggest it's a bit of a mixed bag. You've got strong AI and data center demand, definitely. But that seems to be offsetting some softness in their, let's say, legacy areas.
Right, so things like standard enterprise networking, maybe carrier infrastructure, that's dragging down the overall number.
It seems like it raises that question you hinted at. Are they truly a pure play AI beneficiary yet? Or is that 3.4% growth a sign that, well, the transition is still happening?
And analysts, they're still bullish on the AI angle driving future growth.
They are. They project that AI exposure, especially selling to the big hyperscalers, will pick up steam. They're banking on mid-single-digit growth accelerating soon. That's the core bet, really.
Okay, but here's the really puzzling part for me. Revenue up slightly, fine. But the GAAP net loss, it increased. Went from about $164 million in FY24 to almost $296 million in FY25. How does that happen? That looks bad on the surface.
It does look counterintuitive, absolutely. And when you see revenue rise but losses deepen, it usually points to a strategic decision, not just, poor performance. The reports indicate this bigger loss was driven by some pretty aggressive investments.
Investments like?
Higher R&D spending, research and development, that's a big one. Also some restructuring charges, and notably higher stock-based compensation, or SBC.
Okay, explain that a bit more. Why would those things drive such a big GAAP loss, and why might investors look past it, particularly the stock-based comp part?
Right. So GAAP accounting requires them to book these expenses. R&D is obvious. They're spending heavily to develop the next-gen tech, especially for AI, like 1.6 terabit speeds. That costs a fortune up front. The stock-based comp, the SBC, is basically paying employees partly with stock options or awards. It's a non-cash expense on the books, but it represents dilution and cost.
So it hits the GAAP bottom line, even though cash isn't going out the door for that specific item right now.
Exactly. They're essentially investing heavily today in people in future tech aiming for long-term market share, prioritizing that over showing a GAAP profit right now. It's a trade-off.
And that's why analysts often point to the non-GAAP numbers, to get a sense of the core operation without those big, lumpy, sometimes non-cash items.
Precisely. The non-GAAP gross margin, for instance, was around 61%. That strips out things like SBC amortization and gives you a clearer view of the underlying profitability of what they sell.
61%. How does that stack up? You mentioned legacy peers and giants like NVIDIA earlier.
Yeah, it's sort of in the middle. That 61% is way better than traditional networking companies. But it definitely lags behind, say, NVIDIA, who command premium pricing.
So that margin tells you they have some pricing power due to their tech, but maybe not absolute dominance. They still have to compete hard on price with the big hyperscaler customers.
I think that's a fair assessment.
Yeah.
They're selling sophisticated custom stuff, but their customers are giants who buy in huge volumes and have immense bargaining power. It reflects that competitive tension.
Okay, so they're investing heavily, leading to GAAP losses. But the underlying business has decent non-GAAP margins. To keep funding that R&D and handle things like SBC, they need a solid financial foundation. How does the balance sheet look? Can they sustain this?
Let's look at that. Financially, they seem reasonably positioned for a fabless semiconductor company. They've got about $1.15 billion in cash and equivalents on hand.
And debt.
Total debt is around $4.46 billion.
Yeah.
So that gives you a net debt position of roughly $3.31 billion.
$3.3 billion net debt. Is that considered high, low, manageable?
For a fabless player, it's generally seen as moderate leverage. Remember, they don't have the massive capital costs of owning and running their own chip factories, their fabs.
Right, unlike an Intel or someone who has those huge factory
That's
expenses.
exactly. So that debt level, relative to their likely cash generation, seems manageable.
Speaking of cash generation, this is where it gets interesting again, right? Despite those gap losses we talked about, how was their actual cash flow from operations?
Very strong, actually. Operating cash flow for FY 2025 was $1.3 billion, a really solid number.
Wow, okay. So even with the gap accounting showing a loss, the business itself is churning out over $1 billion in cash.
That's right. And if you subtract their capital expenditures, what they spend on property, equipment, etc., which is about $355 million,
Yeah.
you get a free cash flow, FCF, of roughly $950 million for the year. Almost $1 billion.
That's crucial. That shows the underlying engine is healthy and generating the cash needed to pay down debt, fund R&D, and maybe return some to shareholders, right? Even if the gap profit isn't there yet.
Precisely. It demonstrates the operational health separate from those specific accounting charges and long-term investments.
Okay, let's pivot to their competitive edge, especially in this AI race. Their valuation really seems priced for success here. What's Marvell's key advantage? What are they bringing to the table?
Their main strength, where they're really focused, is custom silicon solutions, specifically for AI and cloud infrastructure. They work closely with the big hyperscalers to provide differentiated, high-speed components. Think things like optical DSPs, digital signal processors for networking.
DSPs, that's for managing the data traffic inside the data center.
Exactly. Especially at incredibly high speeds. They're big in 800 gigabit tech. And crucially, they're pushing hard on the next generation. 1.6 terabit or 1.6T.
1.6T, that's the next big hurdle for AI data centers, isn't it? Handling even more massive amounts of data faster.
It is. It's seen as a potential bottleneck buster. If Marvell can deliver reliable, high-performance 1.6T optical DSPs and related switching silicon before others, or better than others,
Oh.
that's their big play. High exposure to AI growth right there.
But who are they up against? This sounds like a high-stakes game with big players.
Oh, it is. Competition is fierce. You've got the established giants, Broadcom and NVIDIA, offering their own solutions in adjacent or overlapping areas.
Okay, the usual suspects.
Right. But there's another major competitive threat. The hyperscalers themselves. Google, Amazon, Meta. They're all designing more and more of their own custom silicon internally.
So their biggest customers are also potentially their biggest competitors. How serious is that threat?
It's very serious. It's an existential risk, in a way. If a hyperscaler decides they can design a particular chip good enough internally, they might cut Marvell out.
So Marvell constantly has to prove their specialized chips, like that 1.6T DSP, offer significantly better performance or faster time to market or lower total costs than what the customer could do themselves.
That's the race. They have to stay ahead, technically and economically, to keep winning those crucial design slots. Success really hinges on their execution, particularly on delivering these complex, custom silicon programs on time and reliably.
Okay, shifting gears a bit, let's look at the stock chart. As of, say, late September 2025, what's the technical picture telling us?
Well, recently the stock's been trading mostly sideways, kind of consolidating in a range between about $72 and $82 a share.
Consolidation after a run-up, maybe? Is the trend still positive?
The underlying trend still looks positive, yes. The price is currently holding above both its 50-day moving average, which is near $75, and its 200-day moving average, down around $70. So technically, that suggests a mild short-term bullish bias within a longer-term uptrend. The uptrend is still intact.
Is it bumping up against a ceiling, though? Where's the resistance?
Yeah, resistance seems to be forming in that $81 to $85 zone, which is near its recent highs. So it needs a catalyst to break through that level convincingly.
And volatility. Is it a jumpy stock?
It is. Volatility is definitely elevated compared to the broader semiconductor sector. It tends to react quite strongly to any AI-related news or sentiment shifts.
But is it looking overbought or oversold right now? What's the RSI telling you?
The RSI, the Relative Strength Index, is actually pretty neutral, around 58 last I checked. So not signaling overbought or oversold conditions, more like it's waiting, coiling perhaps.
Waiting for that catalyst you mentioned.
Exactly. Which leads us nicely into recent news, and there's been some significant news.
What stands out?
The sources really highlight a very aggressive capital return program that was just announced.
Ah, yes, the big share buyback. Tell us about that.
In September 2025, Marvell's board authorized a massive new $5 billion stock repurchase program.
$5 billion. That's a huge number for a company their size.
It is. And significantly, it includes an immediate $1 billion accelerated share repurchase, or ASR, That means they're buying back $1 billion worth of stock very quickly.
What does a move like that signal to the market? $5 billion is serious commitment.
It signals enormous confidence from management, confidence in their future cash flows, and likely a belief that their stock price is currently undervalued relative to its prospects. It's a strong signal.
Is there any other evidence of that confidence, maybe from insiders?
There is, actually. Concurrent with that buyback news, we saw some insider buying. Specifically, on September 25th, the president of their data center division bought 3,400 shares, right around $78. It's not a massive buy in dollar terms, but insider buying, especially from a key executive in their most important division, is usually seen as a positive sign. They're putting their own money where their mouth is, so to speak.
Okay, that's interesting. But let me push back a bit. $5 billion buyback for a company still showing GAAP losses and needing massive R&D for things like 1.6T. Couldn't that $5 billion be better spent on more R&D? Or maybe strategic acquisitions to bolster their position? Is this the best use of capital?
That's the core debate, isn't it? The bullish interpretation is management feels their current R&D trajectory is sufficient to win the key battles, especially 1.6T, and therefore, returning capital via buybacks to reduce the share count and boost earnings per share is the best way to create value now.
And the bearish or skeptical view?
The skeptical view is that maybe they're seeing how tough the execution challenge is on 1.6T, and the buyback is partly aimed at supporting the stock price and managing volatility while they navigate that high-risk period.
So it could be supreme confidence, or it could be a way to manage perception amid execution risk. Investors have to decide which story they buy into.
Exactly. It's an aggressive capital allocation choice that forces you to take a stand on their execution capabilities.
Okay, beyond the buyback and insider moves, what other near-term events should we be watching for? What could move the needle in the coming months?
Two main things on the financial calendar. First, their next earnings report Q3 of fiscal 2026, which is expected in late November. That will be critical for updates on revenue trends and, crucially, progress on those custom silicon ramps.
Everyone will be listening for commentary on 1.6T wins and timelines there, I imagine.
Absolutely. The second thing is institutional holdings data, the 13F filings, which come out mainly in December. That will show us if the big mutual funds and hedge funds were buying, selling, or holding Marvell during the third quarter.
Right, seeing what the big money is doing can definitely influence sentiment and cause volatility.
It can. Large shifts in institutional ownership can move the stock.
Okay, let's wrap up that looking at the risks. We've talked about opportunities, but every investment has downsides. What are the major risks specific to Marvell?
I'd highlight three key stock-specific risks. First, customer concentration. They rely heavily on a small number of very large hyperscaler customers. Losing even one of those could be a major blow to revenue.
A significant chunk of business gone overnight.
Potentially, yes. Second is that gross margin sensitivity we touched on. Intense pricing pressure from those same big customers could squeeze margins, even if volumes are good.
And the third?
Execution risk. It's paramount. If they stumble on delivering these complex next-gen custom silicon projects, particularly 1.6T, on time and with the required performance, customers have other options, including going internal. It's a huge risk.
And what about broader market or sector risks that could affect Marvell?
Well, the semiconductor industry is famously cyclical. A downturn in global tech spending would hurt almost everyone, including Marvell.
Do any others?
Geopolitics is a big one. U.S.-China tensions, trade restrictions, export controls on advanced chips. These could disrupt supply chains or limit their access to certain markets, particularly China.
That's an ongoing overhang for the whole sector.
It is. And finally, just the sheer competitive intensity from giants like Broadcom and NVIDIA. They are constantly innovating and fighting for the same design wins. Market share is never guaranteed.
Okay, so pulling it all together, what's the general consensus from analysts and what's the overall takeaway from our sources?
Generally, analysts covering Marvell rate it as a buy or overweight. Their price targets seem to mostly cluster in the $85 to $95 range. The overall summary, sort of a blended rating from the materials we reviewed, gives it a solid 7 out of 10. So positive, but acknowledging the risks.
Right. So let's summarize the pros and cons as we see them. On the positive side, definitely there's strong positioning in the critical AI and data center infrastructure market through that custom silicon focus. Also, management seems aligned with shareholders, evidenced by that huge buyback and the insider purchase. The stock's technicals show a long-term uptrend still in place.
Agreed. On the negative side, you have those ongoing GAAP losses, which reflect heavy investment but still need watching. Margins, while good, aren't quite best in class compared to the absolute top tier like NVIDIA. And the valuation is certainly not cheap, reflecting high expectations, which comes with that high volatility we discussed.
So the bottom line conclusion.
The conclusion seems to be that the risk-reward setup looks favorable primarily for long-term growth investors. People who believe the AI infrastructure build-out will continue strongly, and crucially, that Marvell will execute successfully on its 1.6T roadmap. It seems best suited for investors who can tolerate higher risk and volatility for that potential long-term payoff.
And
Near term, given the recent consolidation and the high expectations already baked in, returns might be more range-bound, at least until we get more clarity from the earnings report in November.
Okay, that makes sense. So here's a final thought for you, our listener, to consider. We saw Marvell has strong underlying operating cash flow, nearly $1 billion. We also saw they just launched a massive $5 billion stock buyback. Given the execution risk around their complex new products, will that capital return strategy, just buying back stock, actually prove to be a better driver of the share price in the near term than potentially lumpy gap earnings or waiting for those big 1.6T revenues to fully kick in? Is the buyback the main story for the stock right now, more so than the fundamentals? Something to definitely keep an eye on when those Q3 earnings land in November. Thank you for joining us for this analysis on Marvell Technology. We look forward to connecting with you again soon on Investing Talk Podcast.